The U.S. economy, though, does not need lower interest rates. That's according to Kansas City Fed President Esther, who spoke to Bloomberg's Michael McKee at an annual economic policy symposium in Jackson Hole, Wyoming.
As I look at where the economy is, it's not yet time. I'm not ready to begin to provide more accommodation to the economy without seeing an outlook that suggests the economy's getting weaker here.
Well, hiring has slowed. It's still healthy. Are companies struggling to find workers at this point, or are they cutting back or limiting their hiring because of the uncertainty about where the economy is going?
So the reports we get so far are that businesses are still having a hard time finding people. They are still wrestling with wages and thinking about how to compensate a workforce that they need to be productive. So I think that still is one of their largest concerns, is keeping the workforce they have and figuring out how to compensate them in a way that will keep them.
Well, you know, my next question is going to be, where is that wage pressure that we should be seeing that you've been looking for so long?
So I think we are seeing higher wages. It's true that for a number of years, even as the unemployment rate came down, we were not seeing a pickup in wages. I think over the last couple of years, you have seen that pickup, and I think as productivity has gotten stronger, so the recent releases around that suggest that inflation is not going to pop up in a way that will undermine the workers' ability to realize some gains around that wage growth.
Well, then let me ask you about how you look at monetary policy, because you were an advocate of raising rates to get ahead of inflation. If you're not ready to cut rates, are you happy with where rates are, given that inflation is lower than anticipated? And would you be happy to leave them at this level for quite some time?
So I think that's going to be a process of judging how the economy unfolds. So I think where rates are right now relative to the unemployment rate and inflation suggest we're at a sort of equilibrium right now, and I'd be happy to leave rates here absent seeing either some weakness or some strengthening, some kind of upside risk that would cause me to think rates should be somewhere else.
Where would you put the neutral rate right now relative to where you are? Are you tight? Are you loose? Accommodative? How do you see it?
So I would judge policy to be at neutral or even accommodative with this last rate cut. If you think about where real interest rates are relative to the rate of inflation and where the Fed funds rate is, we're operating close to zero with real rates. I can't believe that that is tight in any sense for the economy right now.
Would you push back against the argument then that the December rate increase was a mistake on the Fed's part?
So I think in my public speeches, my view was we were beginning to see mounting downside risk at that time, and that those were beginning to have some concern about the outlook. It influenced my outlook in terms of flattening a path of policy at that point. But I think as we've judged over the last 2 quarters, the economy has continued to grow, and I think the economy has absorbed that.